increase compared to the budget. We go to the next column, that is previous year amount. Previous year it was 420, and the variance is compared to the 580 current year, variance is 160. Then 160 divided by 420, that is 38.1%. Meaning our current year figures PAT is more than previous year by 38.1%. This is called horizontal analysis. Very easy to calculate and easy to understand. Then we discuss what is called vertical analysis, where in a given statement we take the highest amount figure and calculate individual figures compared to that highest amount figure as a percentage. For example, if you take this statement, the 2016 figures, the highest amount figure is total assets, that is 2,350. Calculate individual figures like land, motor vehicle, furniture, stocks, debtors, cash as against that highest figure. Then how to calculate? In case of land, 1000 divided by 2,350 into 100, that is 43%. In the same way, individual item in this statement you can calculate. For 2016 we took the total asset as the highest figure. For 2015 also same total asset we took and calculate the percentages. Then how do you compare? If you take the land, 2015 it was about 36% of the total assets, but in 2016 it is 43%. It is 43%, right? Now this vertical analysis is very good technique for in comparing different size entities. When you are to compare the different size entities, this is the best technique because to take the horizontal analysis, there can be some interpretation because the size and the other factors won't come to light. If you take a small branch compare with the bigger branch, like Aranaganwila branch comparing Peta branch. Aranaganwila, the figures are very small. Then if you increase in small amount, for example, say Aranaganwila, we gave them a budget of say 10 million for the year, but in Peta it can be 500 million, or it can be more than 2-3 billion, right? Then say 1 billion budget against 10 million budget in Aranaganwila. Peta 1 billion budget PAT, Aranaganwila 10 million. Now if you take Aranaganwila, in the actual figures they have achieved 12 million. Then it is 20% growth. But in Peta they have achieved say 1.1 billion. Their growth figure is, their achievement is against the budget is 10%. Whereas Aranaganwila, after achieving 2 million against the budget, their achievement is 20% or 120% of the budget. But in case of Peta, after achieving 1.1 billion profit, they have 110% target achievement. But compared to Aranaganwila, Peta, you cannot say Peta is not good, right? Now a branch like Peta might be the highest profit contributor for the overall bank's profit, right? Therefore, in that case, the best method is to take these vertical analysis things, right? If you are to, in a credit analysis, if you are to compare different size entities, the best thing is to use this technique. All right. Then we discuss about the ratio analysis. We said performance is a relative term. Ratios are indicators of performance. Show the relative size of financial statement component to another. Ratios are effective when compared with the or when you use the ratio analysis figures with the other figures. Under ratios, we can expect the results in different way, as a percentage, as a rupee term, as a number of times, as a fraction, or as a proportion. Now, this slide was very important. I repeatedly told you, when you are calculating ratios, you may take all figures from the income statement. In order to calculate the particular ratio, you may have to take all figures from the income statement, like gross profit ratio, gross profit and the sales, both are from income statement. In that case, no need to take average figures. Then there are some calculations done under ratios, taking all figures from the balance sheet or the statement of financial position. All figures from the balance sheet or statement of financial position. In that case also, no need to take averages. You can take the asset figure because both figures are taken from the same statement, right? But under C option, where you take one figure from the income statement and one figure from the balance sheet. In that case, you need to take the average figures from the figure that you are need to take from the balance sheet. For example, return on assets. When you're calculating the return on assets, it's say profit before tax return on asset. You have to take the profit before tax before interest from the income statement. In case of the other item, that is assets, where you need to take the average asset. In calculating the average asset, you have to take the year beginning figure and the year end figure, take the total divided by 2 or take the total into 0.5. That's how you calculate the average figures. There can be situations where you are not allowed to calculate the average figures because some figures are missing. In that case also, you are free to take the asset figure instead of now you are not allowed to calculate the average figures and the details are not given, right? In that case also, you can take the asset figures. But wherever the situation permits and the requirement is there and the details are there, you have to take the average figure, especially in part C in this slide, right? Then I mentioned last week, there are 6 categories of ratios. There are 6 categories of ratios. That is profitability ratios, liquidity ratios, working capital ratios, gearing ratios, asset utilization ratios, shareholder or investor relation ratios. Today, lecture is very important because if you, at the inception of this series, I mentioned bulk of the, normally we have a passing percentage of 80% out of the students. 80% students are get through the exam. But last year, last examination, it was about 40 to 50% because of the structural change that we have made to the this examination, where we have 2 separate papers and a student need to get an average mark for individual papers to get a pass. Therefore, the if you take the second part, that is the financial statement analysis, the main part is consist of this particular first question, which will be allocated about 30 to 40 marks. And if you you are not log into the this thing, then you will be in a trouble to calculate the particular answer in a proper way. Because in marking the papers, I noted some people have not even don't know about how to calculate the gross profit ratio, right? If you don't know something, you have to learn it. If you don't know how to calculate gross profit ratio, how come we get through that student? Therefore, it's important today and the last session you log into the this thing and listen to this online session. We can't help because of the COVID-19. That's why we are doing this in this way. Therefore, you have to take the maximum out of this, right? Then we keep on discussing about these categories. First, we took the profitability ratio. Under profitability ratio, we discussed the first one, gross profit ratio. Very easy to calculate. Gross profit divided by sales into 100. I mentioned under gross profit, there cannot be year-to-year variances. The material variances cannot be found because gross profit ratio will be decided on main two factors, that is gross profit and the sales. If you come to the gross profit is you have to calculate by deducting cost of sales from sales. Cost of sales from sales. The cost of sales mainly comprise of purchases, and if there were no material changes in cost of materials, and if there are no material changes in the sales prices, there can be variances in the gross profit ratio. But normally when there are increases in the purchase stocks, automatically the sales prices will get adjusted. Therefore, gross profit ratio needs to be more or less identical from year to year. If you found any in a practical situation also, when you are analyzing a credit proposal, if there are gross profit ratio variances you can found, you have to dig into that in detail and find out the reasons why it was happened. Then next one is the net profit ratio. There also you take the net profit and the sales from the income statement, where in case of a company, net profit means net profit after tax, right? Net profit means net profit after tax. The last item, make sure that you take the net profit after tax, right? You have to read and get the correct figure, net profit after tax, right? And divided it by sales into 100. This ratio, there can be variations, but you have to find why these variations are there. Mainly due to other expenses increase or other income increases. There can be non-related capital nature income and expenses in the income statement, where it should go to the other comprehensive income statement. Therefore, we have to get a good understanding if there are main variations in the net profit ratio also. There can be companies where you have a good gross profit ratio, but when it comes to net profit ratio, there are material declines in the net profit ratio. In that cases, you just merely don't reject the proposal, but you have to find the reasons why that was actually happened. Then this is also a very important ratio. that is interest cover. From the perspective of this concept, repayment capacity, this is one of the things that you can calculate. This is actually the client's repayment capacity calculation, one of the good ratios to get an understanding about his repayment capacity. Here in this ratio, we calculate and we get to know the number of times the client can repay the interest portion using their profit, right? Using the profit of that company, the number of times the client can repay the interest portion. How do you calculate? You take the profit before tax and interest, right? Then divided it by interest again, right? Net profit before tax and interest, or you can add net profit before tax and interest, divided the total amount by total interest. Then higher the number of times, better it is. If it is 10 times, meaning using your net profit before tax and interest, the you can pay 10 times interest, right? 10 times interest. If it is 20 times, then that is a better company than the 10 time company, right? Here interest in the sense what is recorded in the income statement, right? You have to take the interest recorded in the income statement. There also we didn't take any average balances because all figures are from the income statement. Here there is a difference. This is a return on equity. What are the figures that we need to take? The first thing is we have to take the equity, means the actual shareholders or the ordinary shareholders return, right? Equity comprised of ordinary share capital plus reserves. When it comes to this equity, their entitlement is what is left after distributing everything, or after incurring all the expenses, after incurring identifying income, after incurring expenses, after incurring taxes, everything. What is left is the entitlement of these equity holders. Therefore, you have to take net profit after tax, divided it by here average equity into 100. Average equity. Why we take the average in equity? Because net profit after tax is from income statement, equity is from balance sheet. Therefore, the balance sheet figure need to be an average one. Balance sheet figure needs to be an average one. Then this equity normally will be comprised of mainly two things, that is ordinary share capital or stated capital of the ordinary shares plus reserves. Under reserves you have number of reserves where you have this general reserves, retained earnings, various number of, you have to add all the reserves, right? Take the year beginning figure of the equity, year end figure of the equity, and take the average. This is expressed as a percentage, right? This is expressed as a percentage. Higher the percentage, better it is. Higher the percentage, better it is. Right. If you have any problems, you can ask. Right. We can go to the next ratio. That is return on capital employed. Return on capital employed. In this ratio, instead of this equity, we take the debt capital also. We take the debt capital also. Right. How do you calculate? you have to take the net profit before interest and taxes. Here we take the before interest because we take in the other part the long-term debt capital also. Long-term debt capital also. Therefore, take net profit before tax and before interest, divided it by average capital employed. Under capital employed, you have to take the equity capital and the long-term borrowings. Long-term borrowings, they are also, you have to take the average. This is also expressed as a percentage, and higher the ratio, better it is. Higher the ratio, better it is. Right? Make sure you take the equity capital. Now, in a one ratio, now when you are calculating, for example, say under part 3, you calculate return on equity. Return on equity, where you calculate the equity capital and the average equity also. The same thing can be used for, don't again calculate the average equity again for this return on capital employed. The same answer that you calculated under part 3, you can use under part 4 also, right? Therefore, no need to take repetitive actions when your calculations are done by you. Make sure that you take that also. Therefore, you can ignore unnecessary time. We will do at least 2 questions. Then under profitability, another ratio is return on capital assets. Sorry, return on assets. Return on assets. Here also you have to take the net profit after tax. Maybe some cases they take net profit before tax also, right? But whatever the item you take, you have to rename the ratio accordingly. If it is net profit before tax, you have to say answer is ROA, return on assets, before tax. If it is net profit after tax, we have to say the answer, it is return on assets after tax, right? There are you have room to take any before tax or after tax, but make sure that you express in the correct way in the final answer, right? Here also we have to take the average of total assets, year beginning and year end figures, add the total, divided it by 2. And if you take net profit after tax, take the net profit after tax. If you take the net profit before tax, take the net profit before tax. Normally, bulk of the people are taking the net profit after tax, not the before tax. Here in this ratio I mentioned last week, if you take a bank, the ROE is around 1 to 2%. 1 to 2%, right? ROA is around 1 to 2% because they have, even though they have huge assets, their profit figure is compared to assets very low, right? Even though they have a huge asset, number of assets, even a small scale bank, they may have 300 billion total assets, right? You take the top 5 of the banking industry in Sri Lanka, almost all the companies have more than 1 trillion assets, right? But even though they have 1 trillion asset, the profit figure will be very compared to the asset total asset figure. 1 trillion means 1,000 billion, but whereas the profit figure may be 10, 15, 20 billion, right? If it is 20 billion, 2%, because bulk of the we are doing we are accepting deposits and we are giving loans, and there are only few margins for bank to operate. Yeah, in case of 2020, that margins also at a very lower level because of this lower credit growth, deductions in the WPLR. Due to those factors, in 2020 the margins were very low. Therefore, normally in a normal situation also, in a normal year also, Even though banks have uh, material amount of assets in their balance sheet compared to other companies in other industries, their margins are very low, and bulk of the assets are represented by the or the finance through these deposits. Higher the percentage in ROA, better it is. Right. I think we discussed last week up to that point. Right. We will discuss today the liquidity and solvency ratios. Now, if you take this concept of liquidity, liquidity means in a normal business circumstances, how fast you can convert an asset into cash, right? In a normal business situations, how fast an asset can be converted into cash. If that can be done very fast, we say those assets have higher liquidity. If it takes some time, we say those assets, they may have lower liquidity. We will take few examples. If you take cash, no need to convert very, no time will be taken to convert into cash because it is cash itself. Therefore, the highest liquid asset is cash. Then, apart from cash, if you go to the current assets, stocks, debtors, those also can be easily converted into cash within few days. If you take debtors, we can ask them to repay the due amounts. If you take stocks, normally stocks are being converted into cash within a shorter period of time. Those are also high liquid assets. But take land. A land will take some times to convert into cash. You can convert into cash with a lower price, but not under the definition of liquidity. Liquidity is specially mentioned under definition. It says under normal circumstances, right? In a normal situation, if you take a vehicle, if the vehicle is vehicle normal value is 7 million, if you say I will sell this vehicle to 5 million, there can be more buyers. It can be easily converted into cash, right? Lesser than the market value, right? But we are not talking about that liquidity. We are talking about the vehicle selling at least 7 million. If the market value is 7 million, at least 6.5, 6.8 in the price range, right? For that, it will take some time, right? You have to put advertisement. There can be customers comes and see the vehicle. There can be arguments. Likewise, it will take some time. Compared to stocks debtors, it will take material time period to convert your vehicle into cash under normal circumstances. Right? That's why we say the fixed asset or non-current assets, they are poor in liquidity, right? Their liquidity level is very low. Land, building, vehicle, machinery, all the non-current assets, the liquidity level is very low. Whereas the current assets, you have a higher liquidity, right? Now, in these two ratios, we compare bank on all entities liquidity position, whether the company has a good liquidity position or not. Take the first ratio. This is expressed as a proportion, right? This ratio expressed as a proportion, right? You take the current liabilities total then compare it with as a proportion to the current assets, right? Under current asset, you have to take the inventories, trade receivables, mean uh, debtors. Under current liabilities, you have to take the accrued expenses, bank overdraft, creditors, right? Under this, if the current liability is 1, if the current liability is 1, what is the current assets proportion? If you take a live example where the current liability is total is 100, right? Current liabilities total is 100. Current assets total is 200. Then the proportion is 1 is to 2. 1 is to 2. Compared to current liability, what is the proportion of the current assets? And in given situation or situation, the well accepted proportion is for most of the companies is 1 is to 2. 1 is to 2. The current liability, if the current liability is 1, you have to have two current assets. Two current assets in order to maintain the liquidity. Current liabilities means liabilities that you have to settle within 1 year. The liabilities that you have to settle within 1 year. But current assets means the asset that you can realize within 1 year. Therefore, the argument is in order to settle uh, current liabilities, you have to have adequate current assets. If there is no adequate current assets, you have to sell off some of your fixed assets or non-current assets in order to settle the current liabilities. Therefore, normal acceptable norm is when you have current liability of 1, at least you have to have current assets of 2. That is the proportion accepted. Then in the second ratio under liquidity, that is quick asset ratio, where you take off the inventory figure also from the current assets. Normally, we assume that inventories also take considerable time, even though not higher than the selling a vehicle or land. But we say it will also take some considerable time. Therefore, we in the second ratio, we take off inventories from the current asset. Then that is also defined as a quick assets. Quick assets. Higher liquidity assets, right? Then compare it with the current liabilities. There is a norm that it should be 1 is to 1. If the current liability is 1, you have to have quick assets of 1, right? Quick asset means current liability minus inventory. Current liability minus inventory, right? Here also no need to take any average balances because both figures are from the balance sheet, right? Therefore, under liquidity, there are two ratios. First one is current liability to current assets. Second one is current liability to quick assets. Normal acceptable ratio is 1 is to 2 and 1 is to 1. 1 is to 2 and 1 is to 1. But even though I mentioned 1 is to 2, 1 is to 1 is the acceptable ratios, there can be industries where the liquidity is of utmost importance. If you take this banking industry, where we don't find this 1 is to 2, 1 is to 1 ratios, but instead the regulator, the central bank, they have defined 20% liquidity ratio for all the banks, where you have to take the total deposit and you have to maintain 20% of the deposit in your liquid assets. Liquid assets also central bank define. Bulk is from cash, then treasury bills, short-term investments. Those are the liquid assets. Therefore, there can be variation, even though I mentioned 1:2 and 1:1 for acceptable norms. There are industries where you have to have more than that or less than that, right? Special case is the banking industry. Normally, therefore, we can say you have to maintain the average industry level under the liquidity. Average industry level under the liquidity. If a bank's liquidity ratio is less than 20%, central bank will be there to correct that situation, right? Likewise, if you are in other industries, take the industry average and compare it with your entity, and minimally, at least minimally maintain that industry level under liquidity, right? With that, we can move into the next category of ratio, that is working capital ratios. Working capital ratios. Under working capital, there are different kind of ratios. First one is ratios related to inventories. Then the second one is ratios relating to debtors, and third one is ratios relating to creditors. Right. Under working capital ratios, we will first go to the inventory ratios. I will straight away go to the second ratio in this slide, that is stock turnover period. Stock turnover period. Now, how do you calculate this stock turnover period? Stock turnover period equals average stock. Average stock divided by cost of sales into 365 days. Average stock, you have to take the year beginning and year end stock level, divided it by 2. Then you have the average stock, divided it by cost of sales. Cost of sales into 365. Why we took the average part from in the balance sheet figure? That is, we are using one figure from the income statement, one figure from the balance sheet. That's why. Cost of sales from the income statement, stocks or the inventories are from the balance sheets. Therefore, according to our rule, the balance sheet figure should be an average one. Average inventory divided by cost of sales. I am talking about the second ratio. We'll come to the first ratio after discussing the first one, second one. Now, how do you interpret this stock turnover period? Stock turnover means, the meaning is the number of days it will take an inventory to be converted into sales. An inventory item to be converted into sales, the number of days it will take. Right? Higher the number of days, not good. If it is lesser number of days, that is the well accepted one. If the, for example, say after calculating this number of days, one company you have an answer 60 days, meaning it will take 2 months to convert your inventory into sales. Another company, the answer is 15 days. Which company is better? The less amount of days taken company is the better one, converting their inventory into sales. More frequency that you convert into inventory into sales, the better it is. Therefore, a higher number of days is not good. Lesser number of days is good. How do you interpret this ratio? Number of days a company will take to convert their inventory into sales, right? To convert their inventory into sales. Right? I prefer the second ratio that you calculate instead of calculating the first ratio. First ratio is also very easy. There you forget about the number of days. It consider the number of times where you divide cost of sales by average stock. The higher the number of times, it will be better. If you have any questions, you can ask. Right. I prefer the second ratio because it is easy to calculate and easy to understand. Right. Forget about the first ratio. Calculate the second ratio. Right. I again explain or interpret the second ratio where stocks turnover period means number of days the company takes converting their inventory into sales. Therefore, lesser number of days, better it is. Higher number of days, not goods. Similarly, if you go to the next ratio, that is debtors collection period. Debtors collection period. Here also, I'll go to the calculation. Debtors collection period equals average debtors divided by credit sales into 365. Average debtors divided by credit sales into 365. Here we take the stance where number of days your debtors will take to repay their debts. Number of days your debtors, company debtors, will take to repay their debts. The lower the number of days, better it is. Lower the number of days, better it is. If your debtors are taking higher number of days, there can be doubtful dates, there can be bad dates, the administrative problem, your cash is stuck in debtors, right? If the debtors have paid earlier, using that money, you can repay your OD, right? Therefore, debtors collection period, lower number of days, better it is. Lower number of days, better it is. Here, we took the credit sales. If you are not in a position to take the credit sales, you can take the normal sales, right? Assuming that all 100% sales are done on credit basis, right? If the examiner does not give details for you to calculate the credit sales, in that case, you have to take the sales instead of credit sales, right? Assuming that the 100% sales are based on credit, right? If you do have questions, you can raise. Normally, I go to the chat box also. I don't see any questions there. Right. Then under working capital ratios, third one is creditors repayment period. Creditors payment period. Here also we calculate from our side what is the time we take to repay creditors. What is the time we take to repay creditors? How do you calculate? Creditors payment period equals average creditors divided by credit purchases. Credit purchases into 365. Into 365. Average creditors divided by credit purchases into 365. Here we cannot say higher the number of days, better it is, so lower number of days, better it is. If you take creditors, if you are allowed to take higher number of days, meaning your cash is held up with you, right? That creditor have financed your assets, right? If the creditors are given more period under normal condition, the benefit is to your company, not for the creditor. But while saying that also, I am qualifying my statement. If it is the creditors have not been paid because of not giving creditors the higher credit period, because your company having cash flow problems and you are not in a position to repay the creditors. If that is the case, that is not good, right? When you are analyzing a client financial statement, if the creditors payment period is higher than the normal accepted level, say 3 months, 4 months, you have to find reasons why it is 3 months or 6 months, 4 months. If it is due to particular company's ability to get more credit period, then it is fine. If it is due to the company's uh, poor cash management and poor liquidity position, where the company cannot pay their creditors because of they don't have enough funds. If that is the case, that is not good, right? That's why I said creditors payment period should be within an acceptable level. If it is high because of the entity's bargaining power that they have more credit period, then it is fine. But if it is high because of their financial difficulties to repay the creditors, then you have to find a case, right? Now here, the I mentioned how do you calculate the creditors payment period. You have to take the average creditors divided by credit purchases into 365. If you are not in a position to calculate the credit purchases, right? Credit purchases, then you can take the purchases itself, assuming that all the purchases are done on credit basis, right? Then there can be situations where you cannot even calculate the purchases. In that case, there is a formula. Now normally cost of sales is calculated based on, you have to for the purchases you have to add opening stock, deduct the closing stock, then we have to reverse it back to calculate. In order to calculate the purchases, you take the cost of sales, add the closing stock, deduct the opening stock, right? In that way also you can calculate the purchases. But in a situation where you cannot calculate the purchases, if the other details are not given, you can take the cost of sales instead of purchases in order to calculate this ratio, right? First, try to take the credit purchases if the details are given. If the purchases figure is not given, you have to take the cost of sales, add the closing stock, deduct the opening stock, then you have the purchases, right? If you are not in a position to calculate both scenarios I mentioned, in that case, you are free to take the cost of sales instead of purchases. You take the cost of sales instead of purchases in order to calculate this particular ratio, right? Now, after taking those three things, that is inventory turnover period, debtors collection period, and creditors payment period, those are interlinked to each other, because when you are to purchase, when you are to produce stocks, you have to take purchases, right? After you produce inventories, there can be time taken to sell those items. The inventories are being sold on credit basis, then there are debtors also. Therefore, this is like a circle. Uh, Initially, we took the material, then we produce the inventory, then we sell those inventory on credit basis, then there are debtors. Again, you take the cash from the debtors and repay the creditors. Right. Now, that cycle is called working capital cycle. Normally, we add stock turnover period plus debtors collection period, deduct the creditors payment period in order to calculate the working capital cycle of a company. Now, uh, there is a concept called overtrading. Uh, Overtrading concept, if you take, there are few signs where you can see overtrading is done. Overtrading means even though your size is small, you are doing bigger tasks. Right? What are these things? First one is rapid increase in turnover. Your turnover is getting increased very rapidly. Then rapid increase in volumes of current assets. Right? Again, your current assets means debtors, inventories are also getting increased. Uh, Increase in stock turnover period. The stocks become more obsolete and it will take more time to realize into cash, right? That is stock turnover period increasing. Debtors turnover collection period also increased. You have uh, sold on credit basis where the debtors have not paid on time, and creditors payment period likely to increase also, because this is working in a cycles. When inventories are taking more time to convert into sales, then if the debtors are not paying on time, naturally you don't have cash. You take more time to repay your creditors. That is called signs of overtrading. Signs of overtrading. Therefore, you have to realign, restructure your entire process of the working capital according to your size of the company. Um, don't ever unnecessarily increase your sales if you are not ready to do that, right? Therefore, uh, again and again, if your sales are increasing, meaning uh, there are signs of overtrading, right? Right. We'll take a 5-minute break and come back to you. Right. That time is 8:05. I'll start the lecture again at 8:10. There's a question to give a separated for say ratio. I think this is very clear, very easy to understand, and very clear. The tute I have given. If you have a question in understanding that ratio, uh, first you have to take a printout of that and clearly identify what is the how do you calculate the particular ratio. Uh, then second question is asked, why we take credit purchases when calculating credit period, because creditors are come to light because of credit purchases. That's why we take the credit purchases. When it comes to debtors calculation, we take credit sales, because due to credit sales, uh, debtors will come to light. That's why. Uh, if you have any questions, you can raise. If you do have any questions. Overtrading again, can you explain overtrading? Overtrading means situation where you have increase in rapid increase in sales. When you increase rapidly sales, uh, your debtors also normally naturally when you are to increase the sales, either you have to cut down your sales prices, or if you are to sell on credit basis, the sales will increase. When you are selling sales on credit basis, your debtors also will increase. And where situations your current asset, your inventory, everything will get increased automatically. When you do have higher sales, you are producing more and more inventories. But if it is not a natural expansion of your business, if it is on a temporary basis, your stocks will also get increased, your debtors will also get increased, therefore automatically your creditors will also get increased, right? uh, you have to assess whether it is over signs of overtrading or whether it is natural expansions of your business. If it is natural expansions of your business, then there is no problem. But if it is for a temporary period that you came across this overtrading situation, then you have to see whether we are in the right track. Right. Then next category of ratio is gearing ratio. Gearing ratio. If you take the gearing ratio, gearing means how your capital of your business have been financed. In a given company, the capital of a business or the assets of a business can be financed by way of two ways, right? If you take the total assets can be financed in two ways. That is, first one is actual owners put in their capital. We say equity capital, right? Actual owners put the capital to finance assets, right? That is one method of financing your asset. Then the second method of financing your asset is, instead of asking funds from owners, you have to ask funds from the borrowers or other parties other than the owners, right? Like lenders, banks, borrowers, right? From their money, you finance your assets. Therefore, in a given company, assets can be financed in two ways. One is equity holders or the actual owners finance the assets. In that situation, we say equity capital. The second situation where you have borrowers like banks, creditors, lending institute, finance companies. From them, you borrow the money and finance your assets. Those are called debt capital. Those are called debt capital, right? You take the total capital of a company, if it is purely financed by the equity capital, we say that company is a ungeared company or unlevered company. That company have not taken any single cents from the debt capital. They have only taken capital from the equity holders. All the assets in the company have been financed through the actual owner's money, right? Actual owner's money, right? Those companies are called ungeared and unlevered companies. Those are the companies for which that you can easily lend the money, right? If you found any company where all the assets have been financed through the equity capital, then that is a very good company for you to lend. Because under equity capital, if in a capital in a company, when the equity holders have put their money, there is no commitment to repay or commitment to give a return to equity holders, right? If there is only profit, you have to declare dividends. That dividend percentage is also not fixed, right? Therefore, there is no special commitment in respect of these equity holders from the company's side. But if there are debt capital, like loans, debentures, right? Various other sources of debt capital financing, where the company is committed to repay those debt on a regular basis, and company is committed to repay a return also, like interest, right? All these debt capital attract interest expense, right? Therefore, there are two commitments. One is to capital repayment and the second is to interest repayment. Therefore, when you have debt capital, it is not a good situation for a new lender to lend these companies, right? If the total capital, if you take, if it is comprised of only equity capital, we already said those companies are called unlevered ungeared company. Unlevered ungeared company. Then the second category, where total equity capital is more than 50%, where debt capital is less than 50% of the total capital. Say equity capital 70%, debt capital 30%. In that situation, those companies are called ungeared company or low geared company or low levered company. Right? Gearing or levering means using higher debt capital. In this situation, the gearing and leveraging is low. That's why we say low geared or low levered company. 70% equity, 30% debt capital. Then the third category, where debt capital plays a higher percentage of the equity total capital. For example, say our equity portion is say 40%. Debt capital is 60% of the total capital, right? Those companies are called high geared company or high levered company. High geared or high levered company, right? In order to calculate the gearing ratios, we normally use these two gearing ratios are there. Gearing ratio 1 and gearing ratio 2. But you have to first you have to understand how we call a company. Now I said there are three companies. One is only equity capital is there, no debt capital. Right? Those companies are called ungeared, unlevered company. Then the second category of companies, where equity capital is more than 50% compared to debt capital of a company. Those companies are called low geared, low levered company. Low geared, low levered company. Then the third situation, where your debt portion is higher than the 50% of the total capital. Right? Debt capital 60%, equity capital 40%. In that scenario, those companies are called high geared company or high levered company. Right? In order to calculate these high gearing or low gearing company situation, we use to calculate two ratios. One is the debt equity ratio. First ratio is the debt equity ratio. We will see how it will be calculated. We have to first take the prior charge capital, like preference shares capital, long-term borrowings, and debenture capital. Right? Prior charge means you have a commitment where you have to repay the capital portion or the fixed interest portion. Right? If you take preference share also, we normally take for prior charge capital because there is a specific commitment for preference shares, right? We have to pay fixed dividend, whether the profit is there or not, we have to pay fixed dividend, right? Those are debt portion, preference shares. If there are preference shares, if there are long-term borrowing, if there are debenture capital, we take that as a prior charge capital. Then the equity capital will comprise of ordinary share capital, capital reserves, and revenue reserves. Normally, what we took as equity, right? If the ratio is more than 1, we said high geared company or high levered company, it is not a good entity for you to further lend, right? If the ratio is less than 1, we can consider further lending to this institute because it is a low geared company. Right. Under definition 2, where you take the total capital. You take the total capital and compare it with the debt capital, total debt capital. Right. Under definition 2, when we define the debt capital, we take not only the long-term capital. In this first situation, we took only the long-term debt capital. Long-term debt capital. But in this second definition, after taking that long-term debt capital, we add short-term debt capital also. Short-term borrowing also, not the creditors, but the short-term borrowings, right? And we add back the equity capital also and take the total capital. We as a percentage or as a proportion of the total capital, what is the total debt capital, right? Short-term borrowings include bank overdraft and other borrowings less than 1 year. Now, how do you interpret if the ratio is 0.1%, 0.5 and above? We said higher levered company. If it is lower than 0.5, we say lower geared company. Now, we will take an example, right? Now, try to calculate the gearing ratio 1 and gearing ratio 2 for this example. I will give some time. මම හිතනවා දැන් කාලේ ඇති කියලා අපි ගාන හදමු. If you take the first ratio, debt equity capital, they have given the details, share capital, ordinary share capital 1 million, evaluation reserve 300,000, capital reserve 100,000, retained earning 80,000. Where you can calculate easily the equity portion, that is 1.480 million. 1.480 million. Then long-term liabilities, and long-term liabilities, you have bank loan 150,000 and 8% debentures 200,000. That is 350,000. Then under current liabilities, they have given current liabilities, bank overdraft 125,000, short-term loans 25,000, right? That we'll have to take when we calculate the second ratio. We'll calculate the first ratio initially. First ratio is you have to take the equity capital and the debt capital. Debt capital in the sense the long-term debt capital. Long-term debt capital, right? Long-term debt capital. I will try to use the board. I hope you can see the numbers. First, you have to take the debt capital and equity capital. Equity capital 1,480,000. And the long-term debt capital, you have 350,000. Then short-term debt capital, 150,000. Total debt capital, 500,000. Then total capital, equity capital plus debt capital, that is 1,980,000. These are the figures. Hope you can see the figures. The first ratio is and the first ratio you need to compare the you have to take the long-term debt capital and equity capital. Long-term debt capital divided by equity capital. Then the second ratio, take the total debt capital divided by total capital. Total debt capital divided by total capital. Right. Total long-term debt capital divided by equity capital first ratio. Long-term debt capital 350,000 divided by equity capital 1,480,000. Here the second ratio, total debt capital 500,000 divided by total capital 1,980,000. 1,980,000. The answers will be first one 350 divided by 1,480. Answer is 0.36. Sorry, 0.23. This is less than 1. Then the second one, you take 500,000 divided by 1,980. That is also 0.25. Right. If you go to the answers, if it is less than 1 under first scenario, this is less than 1. Less than 1. Therefore, low gear. This is also less than 0.5. That is also low gear situation. First situation, we have to calculate the long-term debt capital against the equity capital. Long-term debt capital here in the example 350,000, right? Then equity capital 1,480,000. 1,480,000. Then the answer is 0.32. 0.23. Less than 1. That is low geared company. Then under second scenario, second ratio, where you have to calculate the total debt capital. Total debt capital, not only the long-term debt capital. Here you have to take the short-term debt capital. Make sure that you are not taking creditors, accrued expenses, those items. You have to take the borrowings and overdraft only. Short-term borrowings and overdraft. Where in the example it's 150,000. Therefore, the total debt capital is not 350 plus 150, 500,000. and compare it with the total capital. Here the total capital, equity capital plus total debt capital, 1,908,000. Therefore, the ratio is 0.25, again less than 0.5, low geared company. In the two situations, we can see this company is a low geared company where you have a chance to lend more to this company. Now, when marking papers, most of the students, I may see more than 10 to 15% of the students uh, uh, may make mistake under this calculation, that is leverage ratio calculation. 10 to 15% of the students are making mistakes, right? Here you have to take first the long-term debt capital, then the short-term debt capital and the equity capital. First ratio is long-term debt capital compared to equity capital. What is the situation? Then add the long-term debt capital and the short-term debt capital both and compare it with the total debt capital, total capital, right? Long-term debt capital and the short-term debt capital add back, and you have the total debt capital. Compare it with the total capital. Total capital. Right. If you have any questions, you can ask now. Or inbox into the text box. Right. Okay. Make sure that you correctly understand this. Otherwise, these will count for your final marks. Because from my point of view, I am trying my level best to pass the students from the exam. Right? You don't find any very flexible examiner like me in this field. I am trying my level best to pass the student from the exam. But unfortunately, students are trying their level best to fail the exam. That's the problem. Therefore, there should be a strike balance between that. So, can you explain what are the main component in the short-term debt capital? Short-term debt capital, short-term in the sense you have to take the current liabilities. Under current liabilities, you have to take only the items that you can take as a debt. For example, here I have given the overdraft and the short-term borrowings. Therefore, main two items are those two. Forget about these accrued expenses. Forget about these creditors, other payables. Those things don't take those as a short-term borrowings, right? Mainly the short-term borrowings comprise of overdraft and short-term loans. I hope it is clear for you, everyone. Thank you for asking that question. Any questions? Shall we move to the next category of ratios? Okay. If you have any question, please disturb me and ask the questions, right? I'll give every chance of clearing your things, because in this situation, you can ask any question, you can make mistake, but in the exam, don't make mistakes, right? I am repeatedly telling, I am trying my level best to pass all the students from the exam. That's why I have very structural scenario where students don't find it very difficult. The exam paper structure itself and the marking also, I am very flexible. Try and level based to give maximum marks to the students. But there are situations where I was compelled to fail the students, where I am also not being given a chance to give some marks to the students. In that situations, it's very difficult to get through students in those categories. Therefore, make sure that you have given a chance to examine as well to pass you, right? Okay, we'll go to the next category of ratios. That is asset utilization, or we are calling those category of ratios as efficiency ratios. Efficiency ratios, right? Under efficiency ratios, we normally see whether our assets are being used efficiently. Whether our assets are being used efficiently compared to other period and other industries and other competitors. Right. First category under this efficiency ratio, so asset utilization ratio is asset turnover ratio. Asset turnover ratio, very easy to calculate. You have to take the turnover, divided it by average total assets. Take the turnover, divided it by average total assets. Average total assets. Why we take the average total asset? Because one item from the income statement, other item from the balance sheet, right? That's why we took average figure from the balance sheet item, right? In this ratio, we see using our assets, how many number of times we can purchase the turnover, right? Higher the number of times, better it is. Higher the number of times, better it is. For example, say company A, they have 100 million assets. Company A, they have 100 million assets. There is another company called company B. They also have 100 million assets, right? Company A has 100 million asset. Company B also have 100 million asset. Using company A's 100 million asset, they have generated, assume 600 million sales. 600 million sales. But in case of company B, they have only generated 400 millions of sales. Both companies had 100 million assets each other. But company A, they have generated 600 million sales. Company B, they have generated only 400 million sales. Right. Which company is efficient then? Right. We have to calculate the asset turnover, divide the turnover by assets. Now, first company, it will come 6 times. Second company, it will come 4 times. 6 times and 4 times. Right? Because turnover divided by total assets. 6 times and 4 times. 600 divided by 100. 400 divided by 100. So which company is better? Higher the number of times, better it is. Higher the number of times, better it is. Use in your sales, how many number of times you can take your total assets, right? That's a kind of a efficiency that we maintain, that we have to maintain, right? If the sufficient data is not available for you to calculate the average total asset, then you can take the year-end figures, right? Then another asset turnover ratio, that is non-current asset to shareholders fund. Non-current assets to shareholders fund. Non-current assets, you know, you have to take the not the current assets, non-current asset. Divided the non-current assets by year-end shareholders fund. Since this is not the both items are from the balance sheet, no need to take average figures. You have to take the year-end figures. The higher the number of time, better it is. Higher the number of time, better it is. This is compared to equity capital. What is our non-current assets? What is our non-current assets? If you do have questions, you have to raise. Right. I'll share my contact. Right. I'll share my contact. Then shareholder relation ratios or investor relation ratios. First, we will take one by one. First one is the ordinary dividend cover. Ordinary dividend cover. This is uh, how many number of times from the profit you have declared your dividend, right? You have to take easily, calculate it very easily. Take the net profit after tax, take the ordinary dividend, then divided the net profit after tax from the dividend, right? Higher the number of times, better it is. Higher the number of times, better it is. First one is the net profit after tax. Then second one is the ordinary dividends, meaning out of the profit, the number of times that you can repay the dividends is the answer, right? Using your profit, how many number of times you can declare the same amount of dividend, right? If it is higher, the better it is. Then next category is, next ratio is under shareholder relations, earning per share. Very famous ratio, earning per share. You have to take the net profit after tax, take the number of ordinary shares. Net profit after tax and take the number of ordinary shares. Now here, the famous mistake, right? Famous mistake most of the students are doing is this, right? When you are to calculate the net profit and the earning per share, there is the dust. Right? Normally in the income statement or balance sheet, we give figures in rupees 1000, right? EPS is, you have to take the net profit after tax. Net profit after tax. Divided it by number of ordinary shares. Right? The famous mistake is, now in the income statement, net profit is given as say in 1000, 10 million, right? 10 million, when you are expressing 10 million in terms of thousands, it's 10,000, right? You take 10,000 here. And in the notes, examiner says you have 1 million ordinary shares. 1 million ordinary shares. Here the figure in thousands. Here the figure in normal terms, 1 million ordinary shares. When you are calculating EPS, most of the students, they take net profit after tax in 1000. Instead of taking the number of shares in 1000, they take straight away this figure, 1 million. Is that correct? No. Right? You have to take this figure also in 1000. This is the famous mistake most of the students are encounter. Right? Now the EPS is then rupees 10 rupees, right? Therefore, make sure that you are not making any of the students in this class not making that mistakes in the exam, right? Please explain again what EPS. EPS here, I took net profit after tax divided by number of shares. I said net profit after tax in the income statement in the paper, it was given as 10,000 in 1,000, right? 10,000 means 10 million. In terms of thousands, it should be 10,000, right? But in normal terms, it is 10 million. But under notes, the number of shares are given as 1 million. Normally, people took this net profit after tax as 10,000, which is not, which is correct. 10,000 in terms of 1,000. But here also you take same figure here. But it is not correct. Where this 10,000, 1 million ordinary shares will have to be converted into thousands. If you convert 1 million into 1,000, it will be 1,000, right? Therefore, rupees 10 is the correct answer. If you take this 1 million as 1 million, then your answer is incorrect, right? It will be like 0.01 rupees, which is incorrect, right? Therefore, make sure that when you are calculating a ratio, if one figure is, if the denominator is in terms of thousands, then the nominator should be also in terms of thousands, right? Asset utilization. Asset utilization, we here also we only take the sales against the assets. Now, if you take assets, you can take total assets, you can take non-current assets, you can take current assets, but every calculation is done in the similar way. You have to deduct, so you have to divide your sales by either total assets, either current assets, or either non-current assets, right? The higher the number of times, the better it is. But here, different ratio, you are comparing your non-current assets with the shareholders fund. Here, no need to take averages. Non-current assets divided by year-end equity capital or year-end shareholders fund. Shareholders fund means equity capital. This is also expressed as a number of times. And a very important message, next week, I am not going to come for the classes. Next week, your classes will be starting at 8:30 as usual. 8:30 a.m. Different person will come and deliver the lectures. 8:30 to 12:30. Week after next, it will be my chance again because of the personal problem. I am not coming next week. Week after next, it will be 7 a.m. again for the final session, right? Therefore, next week, I am repeating, next week, I will not come for the classes, but the classes are there. A different lecture comes and deliver the lectures at 8:30, right? As usual, 8:30 to 12:30. Week after next, it's again my turn. I will come at 7 a.m. and deliver the lectures till 10. And I hope it's very clear. Right. Then we discuss ordinary dividend cover and dividend earning per share. Then next ratio is price earning ratio, PE ratio, where you have to calculate PE ratio you have to take the market price of a share, price per share, divided it by earning per share. Divided it by earning per share. Right? Now, market price per share is the investment you have to invest to purchase a share. That is your investment. Market price per share is the investment you made. And earning per share is the return. Right? Now, in this ratio, P ratio means number of years that you have to wait to realize your investment. Market price per share is the price that you have to make to invest in a one particular share, one single share. Earning per share is the earnings or the return that you have made from that particular share. Therefore, the one is the investment, second one is the return, right? Therefore, the number of years that you have to wait to realize your investment through the EPS. The lower the number, better it is. Lower the number, better it is. If it is now, for example, you are purchasing a share at a 20 rupee, per share, and that share's earning per share is 10 rupees, then it will take 2 years for you to realize your investment, right? Your investment is 20 rupees and your return is 10 rupees per year. Then it will take only 2 years for you to realize your investment. If it is 5 rupee per EPS, then it will take 4 years for you to realize your investment, right? The lower the number PE, better it is. Right. Next one is here. I think dividend per share is not given. You can write down dividend per share means. I will give the formula. Dividend per share in short term we say dividend per share, DPS, total dividend divided by number of shares. Right? Total dividend divided by number of shares, dividend per share. Total dividend divided by number of shares. Right. Then dividend yields means dividend per share divided by market price per share into 100. Dividend per share divided by market price per share into 100. Right? That is dividend yield. Dividend per share is kind of a return as dividend, which is received by the individual shareholder. This earning per share is not received personally by the individual shareholder in cash or any other term. It is the total earning that the company made in respect of these shares. But dividend per share, out of the total earnings, only part will be sent to the shareholders, balance part will be retained as reserves, right? Dividend per share is the what the shareholder will get as cash or scrip. Then the investment is the market price per share. Dividend yield means dividend per share divided by market price per share into 100. Higher the percentage, better it is. Similarly, you can calculate earnings yield also, where instead of dividend per share, you have to take the earning per share divided the market price per share into 100. Right. The higher the percentage, better it is. Higher the percentage, better it is. Right. Next ratio is debt service cover ratio, very famous ratio by yourself. Normally we take net profit before tax and interest, divided it by the total installment figure, that is interest payable in that period plus the capital, right? You have to take the net profit before interest and tax, divided it by the loan capital plus interest figure. That is debt service cover ratio, very famous in the banking industry, but it may the definitions may vary from bank to bank. That is one kind of a limitation when it comes to this ratio analysis. There is no specific definition for these things. Apart from these things, these are some few ratios very famous to banking industry. One is the non-performing ratio. Now this ratio will be a dead animal from this year onward, because central bank also now focusing on impairment side. If time permits, I will share a few slides on impairment and SLFRS. This ratio normally calculate non-performing ratio, NPL ratio calculate, take the non-performing advances divided it by total advances into 100. These days, the all industry and banks non-performing ratio is at a high side. There was a moratorium given to the all customers. Due to that moratorium thing, this ratio has been held up in some extent, but once the moratorium is lifted, we can see the actual scenario of this ratio. Then the second ratio is cost to income ratio, where you have to take the total expenses excluding the bad debts provision, total expenses divided by the total income of the bank, that is net interest income and the other income. The lower the ratio, better it is. This ratio means when you earn 100 rupee income, what is the cost? The lower the ratio, better it is. Now, when it comes to an old branch compared with a newly opened branch, the newly opened branch cost to income ratio may be at a higher side, say 80-90%, but whereas the an old branch will be at a might be even 5% at cost to income ratio, because their income is so high compared to the cost. For a general understanding, the best range is below 40% is good for a bank. Right, net profit per employee, net profit after tax divided by number of employees. That is very easy to calculate and understand. Higher the ratio, better it is. Now, these are the some things that you have to note down when you are writing a paper to the higher authority after analyzing these ratios. Now, if you take the strength side, when the return in excess of standard return, that is a positive point. Now, for example, say in your particular client's industry, the GP ratio is 50%. But in your client case, the GP ratio is 60%. That is an excess of the standard return. That is a strength for a credit evaluation, and you can figure out that particular point. If the standard return is 50%, your client result is 60%, that is a strength from your client side. If the liquidity ratio is in par with the ideal ratio, that is I mentioned, that is 1:2 and 1:1. If those are in par with the industry acceptable level, that is also a strength. If a company had a high net worth or new assets, new worth and new worth in the sense the owner puts more capital and more assets to the company, that is a strength. Then the dividend payment in par or excess of a similar company, that is also strength. But here I'm even though I already said that is a strength, but I am qualifying my statement because sometimes paying higher dividend also not good, right? Taking into a company that is a big in size compared to normal other businesses. Therefore, every time you cannot go to your equity holders or the owners of the company and ask capital. You have to maintain some profits for future use also. Normally, shareholders, they would like to have a higher dividend, but from the company's perspective, you have to maintain strike balance between these two, dividend payment ratio and the retention ratio. You have to maintain some reserves for future use. When you are paying dividend, your cash will go out of the company, right? Your cash will go out of the company. But if it is cash dividend, but if it is a scrip dividend, that is good. Even though you are paying dividend, your dividend will become part of the capital. Scrip dividend is recommended, but normally higher dividend payment also not recommended, because some part has to be retained for future use. Higher credit rating, if your client has a higher credit rating from the independent rating agency, that is also a strength. These are few weaknesses. First one is negative return. If you come across negative GP, negative NP, negative returns, that is not good, right? Weak liquidity. They are as far as weak liquidity is concerned, if they are maintained at the margins, that is also not good, right? Negative net worth and net assets, right? Sometimes people are selling their assets, companies, resulting negative net worth and net assets position, that is not good. Non-payment of dividends, right? If the dividends have not been paid for 2 years, 3 years, that is not a good sign, right? Lower credit rating, right? These are the some weaknesses for you to consider. Then limitation of financial assets analysis tool. Now, even though we mention financial statement tools, this horizontal analysis, vertical analysis, and ratio analysis, they also have some limitations, right? They also have some limitations. They also have some limitations. First one is we only took the historical nature of accounting information. We only talk about the past. This horizontal analysis, vertical analysis, ratio analysis, we talk about the past, right? We take into account all the historical figures only, right? There are companies where in 2019 they have done well, right? If we do an analysis in 2020 with the figures of 2019, we may think that this company is very good and we can offer good credit facilities to these companies. That is based on the historical figures. But there are instances where in 2020 this company has find very difficult to do business in bad condition, low sales, low demand for their goods, very difficult to sustain, right? Therefore, the first limitation is when we are doing this ratio analysis, horizontal analysis, vertical analysis, all these techniques are talking about with the figures of past, right? Make sure that you collect some figures on the present and the future as well before you making a decision. That is a kind of a weakness or limitation in relation to these ratio analysis techniques. Then change in economic condition. The same. This is also very related to the first point I mentioned. Economic conditions are ever changing, especially if you take last year, 2020, due to this pandemic, all the economic conditions have been changed. All the big countries have faced their problems as far as the economy is concerned. I think the hit is very, very high. Now in Sri Lanka, coming back to 2019, you can recall the Easter bomb attack, and our tourism industry got affected. Then we thought that it was the bad year, one of the bad years in Sri Lanka. But we were expecting very good sunrises in 2020. Expectations were very high, and especially the political stability was not there in 2019. And with the political stability, everything 2020, everyone think that it will be a good year for Sri Lanka. But when come this pandemic, COVID-19, right? It was the one of the bad years, right? Now here also in 2021, we think that 2021 will be a good year for Sri Lanka and for the world. But who knows, right? Therefore, change in economic conditions will not reflect in the ratio analysis, right? Because it all talk about the past. If the economic conditions are changed, you have to separately address that thing, not using the ratio analysis, by using different other ways of and conditions. Then sometimes, even though we calculate ratios, there are very limited opportunities for us to compare those figures with the industries, right? Industry average figures are not available, right? Very in few cases now, if you take banking industry, insurance, telecom, we can have industry figures and compare. But there are some other industries where the industry figures are not available for you to compare, right? That is a negative factor as far as this ratio analysis techniques are concerned. Same way, seasonal factors are there also. Now, when you are calculating the ratios, all the seasonal factors you have to eliminate. Otherwise, it will give some erroneous or misleading information for the decision maker. Therefore, that is also not good. Then the quality of reported income, right? All these are accounting entries. All these ratio analysis, we are considering all the financial statements done by the accountant, right? Therefore, sometimes there can be accounting errors or misappropriations. There can be stipulated things in these financial statements. Therefore, the quality of reported income is questionable sometimes, right? You know better than me. If you ask your client to produce some financial statement, they may say they may have a different account sets also. One for the management, one for the inland revenue, one for other institutes, right? Therefore, the quality of accounts or quality of accounting information also will suspend, will doubtfully accept the results of this ratio analysis. Those are the limitations. Right. Next point also, this slide also very important. When you finalize your uh, particular credit paper on the client. Particular credit paper on the client. This side also very important. These are very important point for you to get an understanding or write your paper according to the purpose that we mentioned at the inception. Right? How you interpret the financial statement? Right? First, the interpretation process is assisted by an analytical framework. The main component of the framework are: number one, identification of the use of the analysis. First, you have to see whether this particular credit paper will go to my manager, my regional manager, my zonal manager, or AGM, or DGM, or MD, or senior DGM, or board, right? Or credit committee. There are different kind of authorities for you to put this paper. Therefore, identification of the user of this analysis is very important. If you are putting papers to the board, then you cannot talk about different lengthy things on the client, right? It should be very specific. Now, board may not give you your client, your particular credit paper won't be taken more than 2 minutes or 5 minutes. Therefore, in order to discuss with the important salient points within these 2 or 5 minutes, if it is go to board, you have to present that thing in that way. Therefore, the identification of the use of the analysis is very important before you writing a credit paper. Then an understanding of the nature of the business, industry, and the organization. Right? When you are writing a credit paper on the tea industry, you have to have good understanding about the tea industry. Right? If you have to go to a particular tea factory, you have to get an understanding, you have to have the technical jargons with you. Everything needs to be in tight before you write a credit paper. Get a good understanding of the industry. Then next one is identification of source of data for analysis. From which shows that you take this data. Especially when you are taking the financial information, financial statement, it should be audited financial statement, audited by the external auditors, right? It should be the audited financial statement. It will add more value to your findings or analysis, right? Therefore, when it comes to financial statement, make sure that you take the external auditors financial statement. If the audited financial statements are not there, make sure at least you get the management latest financial statements, right? And subsequently, you take the audited financial statements. Then number 4, numerical analysis of the data available, right? You have to show the, now when you are doing a presentation to the board, the board may comprise of different personalities. One from a lawyer, one from accounting background, one from an engineering background, one may be a famous businessman. Different personalities are there, right? Therefore, make sure that you use very when you are doing a presentation or when you are putting a paper, the numerical analysis are also available. Then the interpretation of the results of the analysis very clearly, right? You should not give room for the decision maker to analyze and interpret, right? You should clearly say your conclusion. GP is higher than the previous year. This is my conclusion, right? Latest turnover is this much. This is my conclusion, right? Therefore, giving numerical data plus the interpretation is very important. Then the writing the report detailing the analysis of the results and recommendation. Very point form. You have to write the report and with the recommendation, whether you are recommending or not, also we have to strongly say in the report. Right. Apart from that, for the exam, I may prefer these points also. Comment on the trend of the ratios computed under each category. Right. You have to comment each category profitability, whether it is good, bad, or whether improvements are noted, or what are the things that to be improved by the client. Then liquidity, working capital, gearing, very clearly mention the interpretation part. After you calculate every ratio category, you have to be very point form and interpret the ratio very correctly. And finally, the recommendation. Then next part is give a risk analysis, right? After you calculate all these ratios, give a risk analysis also identified under each category, whether profitability ratios, if you take, whether it is low risk or high risk. If the profitability ratios are good, all the profitability ratios are good, then you can say the risk is lower, right? Then if the liquidity ratios are good, then you can say liquidity risk is very low. If the liquidity ratios are not good, then you can say under liquidity the risk is high, right? For individual category of ratio, you have to mention whether risk is low, medium, or high. And overall, based on individual categories of risk, overall risk rating you have to give whether it is high, medium, or low. This is also a very essential part of your answer sheet. I will allocate at least 4 to 5 marks for this, right? 4 to 5 marks. Then finally, after you do the analysis, after you do the risk analysis, everything, you have to come to a conclusion where how do I structure these facilities for the client. Normally, the client is requesting more facilities from you, and for that, you are analyzing their financial statements. You have to do the analysis. You have to do the interpretation part, and finally, the risk analysis also you have to do. Right? After everything is done, you have to structure the facilities if you are willing to give more credit to this particular client. Right? Now, normally, the principles of loan structure present the various components of a lending transaction. A lending institute can offer to their borrowers with a view to satisfy their needs. All loans involved in the process may be short-term or to be structured for repayment over longer period of time, depending on the type of facility and the repayment capacity of the borrower. Another advantage is that credit facility can often allow the substitution for a collateral if necessary. It is possible to grant new facilities within the existing approved limit with the extended period of repayment, recover the present outstanding with a view to meet customer requests. The ability to substitute collateral eliminates the need to rework the loan contract, saving both the lender and the borrower's time. The same facilities given by the bank can be restructured with the new risk request, or if you need further collateral, you can ask more collateral from the clients, and based on that, you have to recommend the facilities. Normally, these are the facilities that you can recommend for trade in business and buying and selling, permanent audit, temporary audits, term loans, leasing, pawning, guarantees. For important POD, TOD, LC facilities, term loans is there. For exporters, PODs, TODs, LC, packing credit, and those facilities there. I am not going to explain individual of these categories because there is a separate session done by separate lecturer on these things. But these are the normal things that you can recommend. Right. I have uploaded 2 question papers. One is this 2016 May paper and 2016 November paper. We'll start with the 2016 November paper and we'll complete the maximum possible today itself and continue the balance part for the not next week, week after next. Right. I already stated I am not coming next week. There'll be a separate lecture coming to do the lecture next week at 8:30 a.m. to 12:30 p.m. But I will come week after next and the lecture will be started at 7 a.m. as usual. Right. It will be the final lecture. Right. Now, if you go to this particular case, question, you are the credit officer of Royal Bank PLC. MS Fashion Apparel Private Limited is one of the leading exporters of ready-made garments with a brand name called Butterfly and a prime customer of your bank and maintain satisfactory conduct of current account at your bank. At present, they also enjoy following credit facilities. This is the scenario given. Currently, they have this right. I will give my contact numbers. Now, if you take the industry figures are available normally with your if you take banking industry, central bank is publishing industry figures. If you take insurance industry, that other insurance organizations, they are publishing industry figures. Likewise, the problem is lacking of industry figures for most of the industries for you to compare. But if there are no industry figures by yourself, say for example, you are handling all the hospital companies in your banks, right? For example, you have facility to Navaloka, Asiri, Derdens, and Lang Hospital. Take all the figures from these 4 companies and calculate your industry averages. That is a kind of industry figure, right? Okay, I will give my contact numbers. I will write here in the board. If you want, you can write down. Right. It will be shown in the board at the end of the lecture. You can take down my contact numbers. Right. If you go to the questions again, they have 2 facilities. Term loan approved limit is 80 million and current outstanding is 58 million. Then overdraft approved limit is 10 million. Current outstanding is 16 million. Now they have exceeded the current limit 10 million. The term loan and the overdraft facility are secured by the mortgage bond 90 million on freehold property owned by the company, housing, the office complex and the factory valued at 150 million. Now, if you calculate the exposure, we have given 90 million approved limit against 150 million property. Then if you divide 90 million by 150 into 100, that is 60% exposure, right? We have given 60% exposure. Then second part, if you have a question, you can raise. These facilities were granted 2 years back and the term loan was for a period of 5 years. Then next para, because of the high quality of the products of MS Fashion Apparel Private Limited, there is an increased demand for their brand name products, Butterfly. In order to meet this requirement, the company has to purchase additional machinery at an estimated cost of 10 million and needs additional working capital of 5 million. Therefore, all together requirement is 10 million plus 5 million, 15 million, right? The CFO of MS Fashion Limited had approached your bank for additional facility to meet their requirement. You as the credit officer had requested for the income statement of financial position of the company for the financial year 31/3/2014, 31/3/2015, and 31/3/2016. The summarized audited financial statements for the 3 years are given below. 3 years results are given. Now here the most of the people, not the most, few people. Now if you take this statement, the last item is the retained profit for the year. Now when there are computation using the net profit after tax, instead of taking this net profit after tax, they take this retained profit because it is the last item of the. Don't make those silly mistakes, right? When you are to take the net profit after tax, don't take the last item. That is retained profit for the year, right? There is a separate item called net profit after tax, right? For 2016, it is 51,200. If you take retained profit, it is 11,200. That is totally incorrect, right? Therefore, when you are to take the net profit after tax, you have to take the net profit after tax, right? And the statement of financial position also given, and additional information. You are also given the following additional information. Following balances were extracted from the financial position 31/3/2013. That is 2013 balances also given in order to calculate the average figures. Inventory also given, trade receivable given, trade payable given, retained earnings, that is our reserves, negative figure 20,000 is given. Then total assets, term loans also given. You may assume that the overdraft interest is included in the interest expense amount reflected in the income statement is insignificant. You may use average balances for computation of ratio wherever necessary. And 90% of the sales are on credit basis and 10% are on cash basis, right? The company's stated capital is 112 million from the inception, consisting of 8 million ordinary shares. 8 million ordinary shares. A recent valuation of the property indicated a value of 170 million. Right. Now the requirement is you are required to calculate at least 15 ratios under different categories, and for 15 ratios individual 1 mark is given. Altogether 20 marks is given. 15 for ratios, 5 for ratio analysis, sorry, risk analysis. And the second one is in the event of considering additional facility, describe the type of facilities you may recommend. Number 4, suggest your recommendation to the management of MS Fashion Limited to enhance the financial position without requesting additional facilities from the bank. Right. We will first calculate the ratios. Right. Starting from the profitability ratio, the gross profit ratio. Gross profit ratio. Go to the income statement, take the gross profit for each of these 3 years and take the sales, and you can easily calculate the gross profit ratio. For the first year 2014, no need to take any averages because both points are from the same statements. 161,000 divided by 350,000, the GP ratio is 46%. For the 2015, in the same way, you can calculate it's 43%. For the 2016, it's 41%. 46%, 43% and 41%. There is no much deviation, but there is a slight decline in terms of GP ratio. Slight decline can be observed, but there is no much variation, material variations. We will interpret once we calculate all the ratios, right? No need to explain this GP ratio again and again. I hope it is very clear. Right. The second category of ratio, second ratio under profitability is the net profit ratio. Right. Here you have to take the net profit after tax, divided it by sales. Net profit after tax divided it by sales. Net profit after tax divided it by sales. In 2014, net profit after tax is 39,400, divided it by sales 350,000. Then the answer is 11.26%. 11.26%. Similarly, in 2016, 51,200 divided by 110, answer is 10.04. 10.04. Net profit also in the same range, 11% to 10%, but there is a decline, small decline is there. Small decline is there. Right. Then if you go to the next ratio, that is return on equity, where you have to take the average figures, right? Here, very closely see the calculations. First, you have to take the net profit after tax. There is no issue. You have to directly take the net profit after tax. No issue. Then beginning equity. Now here I took for 2014 92,000. How come this 92,000 came into effect? 92,000. You go to the balance sheet here. At the beginning of the equity, beginning equity means 2013 figures. You have 112,000 here as the stated capital, but the reserves, retained profit is, it was given under note, retained profit is 20,000 minus, 20,000 minus. That's why we have 112 minus 20,000, 92,000. That's why we have here 92,000. 92,000. For 2014, that is 115,400. 115,400. Then the next year 128,200, 139,400. Now here, first you have to take the beginning equity for 2014. That is the beginning equity of ending equity of 2013, right? 92,000 plus 115,400. Take the total and take the average. Similarly, this ending equity will be the beginning equity of 2015. This ending 2015 equity will be the beginning of 2016 equity. Right. Take the total, take the average, and calculate the return on equity. Return on equity. I hope everything is clear. If you have any question, please raise that question, right? I have here in the board, I have given my contact number. If you want to contact, please contact. Right. We'll go to the next category of next ratio under profitability, that is return on capital employed. Here, you have to take the net profit before tax and before interest. Now, before tax is given 56,400, 56,800, 60,200. And you have to add back the interest, 12,600, 16,200, 20,800. Then it will be net profit before tax and before interest, 69,000, 73,000, 81,000. Then take the average capital, average equity capital and average long-term debt capital. Average long-term debt. How you calculate this average equity capital? We can the previous here we have already calculated average equity capital in the previous ratio calculation. From that we can easily calculate get the average equity here.
Excuse me, it will be so fast. Can you explain a little slowly?
Right. Okay.
Okay.
Now, if you take return on capital employed, you have to take net profit before tax, and you have to take the interest, and you have to add back the net profit before tax to the interest. Right? You have to go to the sum right here. From the P&L income statement, you have net profit before interest and tax. Directly, you can take these figures. Because formula, you need to take net profit before tax and before interest. Now we make a note of this 69,000, 73,000 and 81,000. Now I have taken those figures here. 69,000 net profit before tax and interest, 69,000, 73,000 and 81,000. Right? From these income statement, I have taken that thing. Right? Then average equity, if you want, you need to calculate the average capital employed. Average capital employed comprised of two parts. That is, one is average equity capital and the second one is average long-term capital. Long-term debt capital, sorry. Then average equity capital we have already calculated in the previous ratio. Right? Average equity capital. I have taken these figures directly from the previous ratio computation. 103, 700, 121, 800, 133, 800. Right? 103, 700, 121, 800, 133, 800. Then you have a problem of calculating the average long-term debt capital. How you calculate the average long-term debt capital? You have to take the beginning long-term debt capital, ending long-term debt capital, and take the total and divide it by 2. I will explain this 65,000. Right? Now, in order to calculate the average long-term debt capital for 2014, average long-term debt capital for 2014, you have to go to the balance sheet, take the 2014 averages, right? In order to calculate the 2014 average, you have to have two figures, 2013 beginning and 2014 end. The long-term debt here, 80,000 is the long-term debt. Long-term debt is for 2014, 80,000. 80,000, you have to see what is the beginning balance of 2014 or ending balances of 2030 long-term debt. Now go to notes. Under notes, they say term loan is 50,000, 2013. 2013, 50,000. I'll use the board. (2013) 50,000 is the long-term loan. Long-term loan. And 2014 end balance is how much? 80,000. I took it from the balance sheet. Here, 80,000. Then average these days, 130 divided by 2, 65,000. That is the one I took for my ratio calculation here, 65,000. Same way you have to calculate 2015, 2016. Right? Now, average total capital employed equals average equity capital plus the average long-term debt capital. Right? Now here, 103,700 is the equity capital, 65,000 is the debt capital average. Then the average total capital is 168,700, the addition of these two. Right? Then you have to divide net profit before tax and before interest by this figure, and the answer will be 10.26. Sorry, 19.26. Similarly, you have to calculate for 2015 and 2016. Right. Next week, I will explain this again and again, this particular sum again and again. I will give you a chance to calculate yourself. Now, there is no benefit for you to, if I calculate the same thing and again and you take down the things. What is important is for you to first you calculate the things for your from your end and check with the answer sheet. I have given the answer sheet. Now next week, not next week, week after next, I will start it from the beginning of this question. Calculate all the ratios, right? And you have 2 weeks of time for you to calculate for yourself and to check with the answers. If you find it difficult, anything while you're calculating, you can contact me and check with me. I have given my mobile number here in the board, right? If you want to contact when you are calculating, if you find it difficult for anything to be check with me, please contact me. If it is after 5, I prefer. If you want to contact anything, please let me know. Then next week I am not coming. Next week your classes will be at 8:30 to 12:30. Week after next, I'll be join with you for the final session. It will be started at 7 a.m. Right, okay.